What is going on, family? Welcome back to the channel. Hope you're doing well. And yesterday's impressive performance by Fed Powell, of course, led a temporary spike of the dollar. Stocks are running. But what does it really mean for us? We've been talking about cuts this, cuts that, scissors, knives out everywhere. But what does it mean for the average investor in crypto? And where do we go from here when the prices haven't really skyrocketed? Neither have we dumped. So when is the dump most likely to happen? And do we start just going on a crazy bull run from here? So the chances are, guys, things are looking good and things are looking a lot more clearer to the market. What the amazing thing was, again, was the multiple cuts that the Fed is planning for the next two meetings. So this is a 3-rate cut situation this year. And what I do like is, although tariffs came up several times, what he really emphasized on yesterday was the fact that the labor market needed an urgent attention. And as a result, stock markets hit a fresh record highs and everybody's bullish. But rather than give us one big hit of a major 50 basis points, was to have a unanimous agreement from their side to say, guys, we are going to gradually ease this monetary policy. And again, slow and steady is great for the market. We were live yesterday. Of course, market has reacted. ETH up, a lot of the ecosystem cryptocurrencies are bouncing. But I wanted to take a step further. Just to recap the things that he said. Now, the one point of mentioning the T word, of course, every time the T word comes out, the tariffs, and again, the interest rate cuts being anchored in a time when we're seeing a slowdown of the US labor market. And this kind of got us out of jail yesterday. Check this out. So basically, he kind of said, yes, this is exactly what was going on. And that for me was quite key because, of course, Donald Trump has not really relented in his tariffs. They did announce a pause. But what does this mean? What does it mean for us overall, right? So that's what we want to know. What does this mean for us? So when you have a cut, and a lot of people, and I wanted to do this video because a lot of people didn't really understand exactly what the hell are they cutting? Is it a ribbon? Is it interest rates only? How does it impact me on a day-to-day basis? So the rates, okay, in which the banks, and I'm going to try and keep this as simple as possible, rates fall. So you get a lower borrowing rate. I'm not even going to use the word interest rate, borrowing rate, okay? And therefore, overall, the banking overnight lending becomes way more accessible and cheaper for consumers, okay? And we're talking about people, real lives, everyday credit cards, all these types of things, okay? And then, so if we say overall, when you have the rates fall, then you kind of move to this scenario where you've already got, of course, the rates fall, becomes cheaper, overall cost of borrowing. Okay. Because people don't know this stuff, man. Like, it honestly, crypto is never going to pump. Cost of borrowing comes down. It's all one big interlinked money, kind of lubricating the entire system kind of setup. So what happens is when the cost of borrowing falls, then what happens here is we get loans, right? You get loans plus mortgages. Because right now, you saw the report the other day, the cost of mortgage is just unattainable. So you get mortgages, loans, and business loans as well. So all this means is credit lines, right? Credit. How many times did you want to buy a new car? And of course, you had poor credit, or the rules for you to hit a certain amount of points in your credit score were way too high. So the financial system gets relaxed. There's a lot more money, and you're going to start seeing those phone calls. Would you like to borrow this? Would you like to borrow that? And again, the cycle is a vicious cycle that never ends. It just continues every time to happen again. So I hope you're with me so far. So 1 and 2, cost of borrowing, credit lines, of course, mortgage rates, overnight lending. By borrowing, lowering the borrowing costs, okay? So lower borrowing costs, okay? And I know, sorry, a lot of you know this, equals to, right? It's easy. It increases and enhances the amount of money you can. That's what they want us to do, man. You know, and you know, a lot of people fall victim to this. You know, you want assets, not liabilities. But this is why the system is just inherently flawed. Not that we're going to complain right now. You know, complain when the bear market is here, but not now. It is absolutely insane. And then, and what happens is, of course, people start spending more, and as a result, you have banks, right? You have banks plus institutions in general, just providing, you know, more liquidity. It's as simple as that. I mean, again, you have lower borrowing costs, and the way the banks do that is they basically hold less cash, right? So they don't keep cash reserves, and they push money into circulation. So banks make it possible. So banks hold less cash, right? Because the times are not, you know, it's a risk off environment. So they hold less cash. So they are not being tight, right? So they open the safe, basically open the safe box. And then what you get with that is, because they're holding less cash in available and in reserve, what they do is they push that money. So they push, right, into circulation. So when you talk about, think of, you know, circulation. So think of all this money now swashing around the system. Not as crazy as we saw in COVID, but the banks are now actively giving out loans, making credit more available. And of course, the Fed is printed in the background. So all that does is it does one giant, sorry, excuse this. This is a syringe. So one giant injection, right? And let's say this is an arm. You know, this is Mr. T. Mr. T's arm, funny arm anyway. But what they do is they inject all this money into the system. So once you get this injection, now people have stupid amounts of money. There's a lot of money going in circulation, and of course, then you have the return to what we know best. So first, you know, lower the rates, you reduce the return of safe assets like treasuries, saving accounts. So basically, treasuries. Okay, so treasuries plus savings, right? So during a time like this, you don't want to be saving because you get lower interest. So you get lower interest. So they really suffer because they're not really, and money market funds in general, there's not a lot that's happening here because, of course, what's the point of saving with a lower interest rate, right? And then what happens is the investors move out of these low yields. So it's a snowball. So these are what we call low yields. Now imagine where we are. So we are at the opposite end. We are the most riskiest, the highest yield, highest returns in the history of the world. And that is crypto, right? So this whole thing is not it's not designed for, it's not designed for cryptocurrency, let's say, but we benefit because we can lose all our money in such a short amount of time. So because you have key, lending and borrowing, savings and treasuries, just basically giving you very low yields for your money, then what happens is those that are seeking to gain greater returns and higher yields move out of these, and they're like, you know what, screw this. We are not going to go directly to crypto, but let's go stocks, right? So they look at stocks, they look at crypto, they look at other investments that can give you more returns. Okay. So what that leads to is what we call credit expansion. So the credit expands, and then you have obviously all this money coming out of these lower yields, safe assets, and they come directly to this. Now, of course, what that means is households, first of all, get a relief. And households are, of course, important. Credit expands into households. People are buying more homes. Companies are investing more. Economy is stimulated. Multiple, the velocity of the money. Same dollar changes hands frequently, right? A real flood of money coming into the market. So how does this then impact you? Because you are in the most riskiest of risky assets. And that is crypto, my friends. So the way that impacts you is the QE phase allows investors to come into rotation into tech stocks, stock market, and definitely crypto assets. And of course, we saw partially, you saw massive movements into that psychologically cheaper money, bullish sentiment, and speculation appetite grows. And capital rotation, of course, comes from, goes from stocks, right, into tech, your tech companies, and then finally, of course, even though into crypto. And then within crypto, we have the money flow. So we have large caps. So we have BTC plus ETH, right? We've seen that rotation between them with BlackRock. Then we have large caps. The money comes down to large caps. And then from large caps, the money then goes into mid caps. This mid caps. And then finally, your dirty degen low cap gems get some much needed 100x moves. And there are a lot of money is made here. Now, because of the way the risk of the market is, I would be looking to buy more of these riskier assets as the market stabilizes a bit more, because what we have positioned ourselves is we are in the large caps, we are in the mid caps, but sometimes a lot of us are way more into the low caps, and the rotation hasn't even started the way that it naturally should. So that is a brief lesson on how the money supply, circulation of money, money changing hands, in absolute layman terms, that's how it goes. And that's how our cryptocurrencies will inflate. And that's how we're going to expect these multiple, whatever, 20, 30, 40x's, whatever we're going to get. So this is the most bullish event. The Fed will, again, we saw the dot plot yesterday. The Fed is in a complete agreement for 3 rate cuts, 1 down, 2 to go, move over to April. October and November is going to be super interesting up to December this year. We may even see a cycle top, in my opinion. So guys, let me know what you're buying. Stay bullish. This is probably one of the most important videos that you're going to watch, because you're going to understand rate cuts. Okay. The way, again, I'd like to just reiterate, because again, people don't understand these things. Rate cuts, right, equal to more borrowing. Okay. More borrowing, which then equals to more liquidity, which then equals to lower yields, because traditional safe assets don't offer you, your saving account is not going to do a lot for you, right? And then money then comes out, pouring out of this low yield assets, and money goes heavily into high risk, high risk assets like crypto, tech, and stock. Smash a like. That explains everything to you. Take care. I'll see you on the next one, guys. God bless you all.